Thanks everyone for joining us today. My name is Elie Youssef. I'm a director at Venero Capital Advisors, and I'd like to kick off today with a story. So over the next 35 minutes, we'll walk you through the process we use to get a multi-billion-dollar Nasdaq-listed company interested in a privately owned European software business generating just a few $1 million in revenue. When the buyer first entered the process, they submitted one of the weakest offers on the table. By the end of the process, they became the winning bidder, acquired the business at a premium valuation, and the shareholders walked away with 80% of the consideration in cash. Nothing about the business changed during that process. Revenue didn't double. Margins didn't suddenly improve. There wasn't a breakthrough product launch. What changed was the way the opportunity was positioned, how the buyer understood the business, and how the process itself was managed. That's what today's session is really about. Most founders think valuation is driven by a multiple. In reality, valuation is heavily influenced by preparation, positioning, buyer psychology, process execution, and of course, market timing. All those things can materially change the outcome of a transaction long before anyone submits an offer. During today's session and the following 5 webinars, we're going to show you how sophisticated buyers actually think, what they look for when underwriting an acquisition, the practical steps founders can take to maximize value before they ever go to market. We'll start with accessible concepts to establish a baseline, and then we'll get progressively more advanced as the sessions progress. And all of the examples we'll discuss come directly from live processes and real buyer interactions rather than theory. So before we kick off, a word from Georgios, Venero's managing partner.
Yeah, thanks, Elie. Excited to be in this webinar. As Elie mentioned, we're doing a series of webinars and we repeat them over time, different topics every time. We start with a high-level overview of what we feel is a winning process, tips and tricks, and lessons learned from countless mandates. And then we can drill deeper depending on the particular theme or even the question that we receive from you guys. Maybe I'll tell you a bit about my background. So I've been now with Venero for about almost 10 years. I was at Deutsche Bank and Morgan Stanley before that, doing M&A in the multi-billion-dollar ranges at the bulge bracket investment banks across EMEA, and then for the last 10 years or so, focusing on the mid and lower market, transactions, tech and tech-enabled services, with particular expertise in certain industries. The lessons are very similar, so across sizes and across geographies. M&A is it's a people process. So while every situation is different, there's a lot of experiences that can be transferred from one situation to the next. And then this is what we're trying to share here with you guys as well. Elie, maybe a bit about yourself as well.
Thanks, Georgios. Yeah, I joined Venero at the turn of the year. Before that, I was with another investment bank focused on founder-led tech businesses. And before that, I was a 2-time founder myself, 2 exits, one decent, one not so decent, both in technology businesses. As a typical entrepreneur, I thought I could run the process myself, and I made a lot of mistakes and left a lot of money on the table. So I spend my time now helping founders and CEOs navigate through M&A and maximize their outcomes. So yeah, very pleased to be presenting today. Georgios?
Yeah, maybe a bit about Venero for those of you who don't know us already. So Venero, we're a corporate finance advisor offering 3 things, primarily sell-side M&A for focusing on founder-led businesses. So we help founders explore their options and help them maximize the value out of what is typically probably the most important transaction in their career. Typically, founders will have 1, 2, maximum 3 liquidity events, and our goal here is to make these events highly successful for the founders. We also support the founders on equity capital raisings and debt financing advisory. A bit about how we do things differently versus some other corporate finance advisors. So we are what we call partner-led or senior banker-led. So every deal, every mandate has a senior banker that leads it from beginning to end. We don't hand it off to a junior and sit in the back. So we are partner-led. We have an international coverage, international network of buyers that we know very well, and that's also important because almost 90%, at least 85 to even more percent of all the deals that we've done are cross-border. A lot of times we even find that sometimes in-market buyers tend to even underpay relative to out-of-market international buyers. So having this international network is critically important. And of course, the market insights that we bring to the table, depending on the sector and the region, are also critical to the success of the mandates. Next slide. Yeah, a bit about the team. So Elie and myself, you heard about, but we have folks sitting across Europe, North America, South America, and we run mandates globally. So from Southeast Asia and Australia to across all the major markets, we cover clients across the region. And yeah, so I think that's a bit about. Oh, sorry, one more thing. In terms of deal sizes, typically we focus on the mid and lower market, so enterprise values from the low, tens of millions to a few hundred million, so about 300-400 million in enterprise value. That's our sweet spot. And yeah, some of our transactions, the lessons learned and the experience that we draw upon during these webinars are from these transactions. We have success stories on our website that you can look up yourselves and some lessons there. But we'll hope to touch on a few nuggets during these sessions. Elie?
All right, thanks, Georgios. Okay, so let's get started. Today's webinar really revolves around one main theme, and that's how do you maximize the chances of a successful exit before you ever speak to a buyer. Most founders and CEOs spend their time thinking about valuation, buyers, or deal terms. In our experience, all those are outcomes. The process that leads to them starts much earlier with your operating model, how you run your business. So we'll walk you through what a professional sell-side process actually looks like, from getting the business ready for market through to negotiating and closing the transaction. We'll look at where founders most often lose leverage, the mistakes that quietly derail deals, and the practical steps that consistently improve both deal certainty and shareholder outcomes. So hopefully by the end of the session, you'll have a much clearer understanding of how experienced advisors think about preparing and running an M&A process from start to finish while protecting your upside. So let's start with a misconception. Most founders think exits start when information memorandum goes out. In reality, by that point, a lot of the outcome has already been shaped. Buyers don't usually or don't suddenly decide a business is worth more because they receive a teaser. Their conviction is built from what sits underneath the business, which is the story. The business fundamentals, the quality of the materials, the clarity of the numbers, and the way the opportunity is positioned. So from that perspective, the strongest exits we see usually have three things in common. First is methodical preparation. The numbers are clean, the KPIs are consistent, the legal housekeeping is in order, and management can answer difficult questions without scrambling. Second, strategic positioning. The company is framed around why a buyer should care, why the market opportunity matters now, and why the asset is difficult to replicate. And third is disciplined execution. The buyer universe is sequenced properly, information is controlled, momentum is maintained, and no single buyer gets too much leverage too early. That's how great exits are built long before the first buyer call. It starts with your business, your day-to-day operating model. If you only start preparing once a buyer is already interested, you're usually reacting and you're working from a weaker position. Many founders think M&A is about finding buyers and negotiating price, but that view is far too narrow. A professional sell-side process moves through four connected stages. The first is readiness, second is market engagement, third is negotiation, and fourth is closing. These stages are not separate boxes. They don't work in isolation or in a vacuum. each one affects leverage in the next. So weak preparation becomes weak engagement because now you're reacting versus leading on the front foot. Weak engagement becomes weak negotiation, and weak negotiation usually produces a weaker close. The reason that matters is that valuation isn't discovered in one moment. It's built progressively through the quality of the business, the clarity of the narrative, the structure of buyer outreach, and the control of the process, all the way through to signing and getting paid. Each stage builds on the one before it, and together they support a stronger close. Weakness in one stage will compound in the next, and that's why the best exits are built and not improvised. It's also why CEOs and founders should stop thinking of M&A as a last-minute event or the end, and start treating it as a business discipline well before any buyer conversations begins. So let's dive deeper into the stages. Stage one is readiness. This is where the real work starts. The most successful exits often begin months before approaching the market, and the reason for that is because issues buyers care about don't get fixed in a few weeks. Revenue quality takes time to improve, KPI consistency takes time, management depth takes time, legal cleanup takes time. I'll give you an example. If the founder is still central to sales, product customer relationships, and decision making, buyers will absolutely price that as risk. The same goes for inconsistent contracts, messy reporting, weak IP documentation, or unclear definitions behind core metrics. So good preparation is about removing avoidable reasons for a buyer to discount the business. And another misconception is around timing in relation to your business's KPI trajectory. And this one is critical. Some founders have a target in their mind, could be qualitative or quantitative. And, we hear them say things like, we'll go to market when X happens or when we get to Y. And the risk here is waiting too long and you start the process during a deceleration. The best time to sell your business is while you're growing and you're still on the up. Buyers aren't going to reward you for your performance 2 years ago. They're going to reward you for where you are today and where you're going, if that direction is up, of course.
And this is actually a very important point because founders and CEOs sometimes believe that they will miss out, right? If the company is on the right trajectory, they might miss out or leave money on the table by exiting while things are still going well. In fact, it's quite the opposite because, like you said, buyers reward you and pay for what the future holds, right? So if you're on an upward trajectory, the valuation multiple will reflect that upside potential, right? If you're on the downside on a downside trajectory, even if it's just 1 year, that multiple will reflect an envisioned future whereby the company continues to decline. Right? Of course, the seller and their advisor will try to position this as, oh, it was only a temporary slowdown, things will pick up again. But usually buyers, they take that with a grain of salt, and there's a good possibility that you go to market from a position of weakness. So yeah, don't be shy about exiting when things are going well.
The second stage is market engagement. So once the business is properly prepared, the next step is positioning in a way buyers can understand and value correctly. Reaching out to buyers is straightforward. The real challenge is making sure they understand why your business deserves their attention, which is the narrative. And you'll hear that word a lot, narrative. So what does it mean? Buyers don't value raw information in isolation. They value a clear strategic story supported by credible facts. In our experience, we see competitive differentiation and market positioning as critical because buyers need to understand not just what the company does, but why it matters and why it wins. If you don't frame your company properly, the buyer will do it for you, and they'll usually frame it around risk rather than upside, which translates to discounting the value. So let me give you a real-life example of this. We had a client that churned 2 large enterprise accounts, which heavily impacted their gross revenue retention, and it brought it down below the market threshold. So in the materials, we need to control that narrative to get past the gatekeepers on the buy side that are scanning to see if this opportunity ticks all their boxes. So long story short, we explained that these were 2 outlier enterprise accounts that had both been with the company for about a decade each, and that the global teams on their client side wanted to shift to an end-to-end solution in line with their global policy versus a point solution, which is what this was. So we're signaling here that there was nothing wrong with the platform. The needs of the client changed. So if you cast out these 2 outliers from the analysis, the gross revenue retention is actually quite attractive and in line with market. So That's a very simplistic way, or a very simplistic example of how you control the narrative and be proactive versus reactive. The message here is we need to understand how buyers view the business and the metrics from their lens and build the story around that. And also obviously remember we're selling the business and not the product. So it's important to build the narrative around why certain things in the business happen.
Yeah, and one more thing I would probably add to the narrative. Actually, a couple of things. First thing is a lot of founders and CEOs, they think they know the business, and they do. You guys know your business better than anyone. The tricky part is you don't necessarily always know two things. You don't know what everyone else is saying. So a lot of times we will hear from founders or CEOs to hear them bragging about XYZ and how great their business is because XYZ. Now, we talk to 10, 20, 100 other founders, and we have the perspective that everyone else, or almost everyone else, may also be saying the same thing. So something that you guys might feel is a differentiator, right? Someone who has a broader perspective is able to tell you, well, okay, I hear you. This is a strength, but this is how you might position it slightly differently versus what everyone else is actually also saying. So that's one. The second thing that founders often miss out on is how buyers would perceive them, right? So they know what they like about their own company, right? So they might brag about that, but buyers might value something else, right? A seasoned advisor will also bring that into perspective, and they will say, "Look, I hear you. These are your strengths, but you also need to watch out about these things. You should highlight this because this is more important in this situation to that buyer." So when you shape the narrative, having the broader context is very critical.
Thanks, Georgios. Stage 3 is negotiation and bidder management. This stage founders tend to think about first. Ironically, by the time you get here, much of the outcome's already been shaped. Negotiation isn't about pushing for a higher number. What you're trying to do is create an environment where buyers feel they need to put their best foot forward. That's why we spend so much time creating that competitive tension early in the process. Once a buyer knows they're generally competing, the conversation changes. It's no longer just about valuation. They start competing on cash at closing, earnouts, escrow provisions, and other terms. So it really becomes a shift in psychology. And those terms can make a significant difference to what you actually walk away with. Leverage doesn't just come from simply telling a buyer your business is worth more. It comes from giving them a credible reason to believe someone else may be prepared to pay more for your business. And that's a very different dynamic. Finally, sequencing matters. If one buyer gets too far ahead too early, they'll often ask for exclusivity before you've had the opportunity to meaningfully develop, explore the market. And once that happens, your leverage usually starts moving in the wrong direction. We see all the time with unsolicited inbound interest. It's definitely flattering for someone to show interest in your business, but remember that one buyer doesn't make a market. So a well-managed process keeps buyers moving at roughly the same pace through that process. So when the offers arrive, you're choosing between alternatives rather than negotiating from a single position. And that's the mistake that I made when I was a founder. I thought I could do it myself. I thought I prepared the best data pack, and I may have, but I was only speaking to one buyer, so it didn't matter because I had no leverage. And that buyer knew it.
And I mean, this is a topic in and of itself, right? Negotiating and managing the buyers. So it's a very human situation. There's cues from verbal signaling, non-verbal signaling. Negotiation is, it's not a formula. It's a narrative. It's a discussion. It's a conversation. So experience in dealing with situations, giving answers, understanding what the buyer means when they ask a question, understanding what your answer might be, or how your answer might be interpreted by the buyer. These are all things that come with experience, and an experienced advisor can certainly help you navigate those properly.
Yeah, which leads us perfectly into closing. This is where founders often relax too early, and that's a mistake. The deal is not done at LOI by any means. So if you're not on top of it, or if you're suffering from deal fatigue, this is where, this is where we say deals come to die. In many cases, the hardest value protection work starts after exclusivity begins. That's when there's a shift in leverage from the seller to the buyer. Our playbook highlights exactly the kind of terms buyers pressure test at this stage, and that ranges from cohort levels, revenue data, customer concentration, retention, IP ownership, compliance, technical architecture, you name it, legal. This is also where legal mechanics start to matter a lot more. That includes escrows, indemnities, purchase price adjustments, and disclosure schedules. And how you respond during due diligence is just as important as what you respond with. Quality of materials, timeliness of responses, consistency in communication, all of that matters. If the business is not diligence ready, the buyer will price that risk in, whether through delays, retrades, or tougher legal terms. And I'll give you an example. I was involved in a deal a couple of years ago where the buyer appeared to have a playbook for retrading at different stages of diligence. It was like clockwork. And if we weren't on top of it and properly prepared, they would have taken us to the cleaners. So who actually shapes the outcome? Every transaction is influenced by a lot more people than you'd expect. You're not selling to one person, you're selling to an organization. On one of our recent transactions, there were about over 90 individuals from the buyer side, which was more than double the number of employees on the sell side, who had access to the data room. That wasn't necessarily 90 decision makers. It was, product teams, engineers, finance, legal, admin, IT, tax advisory, etc. That's why information control becomes really important. Not everyone needs to see everything. The product team doesn't need to see the employee contracts. HR doesn't need detailed product architecture. If the wrong information reaches the wrong person, they can raise concerns without having the context to understand what they're looking at. And once that happens, you're playing defense instead of controlling the narrative. So a well-managed process controls not only what information is shared, but who receives it, when they receive it, and why they need it.
Yeah, and actually, one more example. You never know who affects the outcome. So in one situation, there was a junior analyst on the buy side who was crunching the numbers on churn, retention, growth rate, and whatnot, and the senior team members relied on that person's analysis. Now, if that person got the numbers wrong, if that person didn't get the narrative, yeah, there would be nobody above him to challenge him. So and we realized that person was getting the numbers wrong. They were getting the narrative wrong. The challenge there was to make sure that person didn't create false impressions, because once an impression is created, in someone's head about, oh, this company has high churn, or it's not growing fast enough, and then, like Elie said, you're playing defense. You need to take that back. So in that particular situation, we actually asked for the analyst model, which was, typically buyers don't share their models with the sellers. In this particular case, we got the model, and we actually walked that person through the analysis, through their formulas, to make sure that what he was presenting to his IC and to his seniors was accurate and consistent with the narrative that we thought was the right narrative for the business. But if we hadn't done that, right, then it would have been a complete miscommunication of the wrong numbers and a mismatched narrative, and it would have been a disaster. So you never know who actually shapes the outcome. In this case, it could have been a junior analyst running the model for the buyer.
Yeah, that's all it takes. One person to torpedo a deal.
Yeah.
So let's look at process timelines and common failure points. So one of the first questions we get asked by founders is, how long does it take? How long does the sale process take? And most are surprised by the answer, but in our opinion, the first question you actually really need to ask yourself is, are you solving for time, or are you trying to maximize value? And the distinction is very important, because the outcomes are very different. If you're solving for maximum value and you're running a proper process, there are lots of moving parts, and each one builds on the previous stage. So you need time to prepare the business, you need to identify the buyers, manage the meetings, evaluate the offers, complete diligence, negotiation, and the legal documents. Looking at the timeline on the slide, preparation usually takes around 4 to 6 weeks. That's where we align shareholder objectives. We prepare the materials and make sure the business is ready before a buyer even sees it. Once the process launches, things can move quite quickly. Buyer outreach, management meetings, and first round offers can come in within a matter of weeks if everyone's aligned. The final stage is usually the longest. That's diligence, SPA negotiations, closing mechanics. All that takes time because buyers are validating everything they've been told throughout the process. One mistake we see quite regularly is founders trying to save time by rushing the preparation. In practice, it usually has the opposite effect. The issues that weren't addressed upfront tend to surface during diligence, and that's when the process slows down and you start to chip away at trust.
And look, I mean, we also always take guidance from you guys as clients, right? So from the shareholders and the board, if they tell us, look, for whatever reason, we need to transact by a certain date, or we need to move quickly. And there's many reasons why someone might want to move quickly. Of course, we take that into account. And every process can be crafted differently, right? Some things can be shortened, others can be expedited, others cannot. But we always take the lead from what the board and the shareholders and the founders want as an objective. But sometimes doing things properly helps the transaction close faster than if you rush through things with the objective of getting things done more quickly, because then, as Elie said, these things will come back and then they will throw out delays and they will mess things up. So sometimes it's better to do things properly in order to move more quickly.
And there are a handful of moments in every process where experience and judgment matters disproportionately. The first is deciding when the company is actually ready to engage buyers. The second is deciding which buyers to approach and in what order. Some are fast, some are quick. We don't want to go out to someone who can put an offer quickly on the table and ask them to wait 2 months while we calibrate the market. The third is deciding whether to frame valuation expectations early or let competitive tension do some of the work. And the fourth is choosing which LOI to back, because most of the time, the highest headline number is not always the best path to close. Structure is very important. How much cash up front? What's the earnout? Is the earnout achievable? Certainty, buyer quality, strategic fit matter alongside valuation. So in other words, value is shaped by a sequence of decisions, not just one dramatic negotiation moment.
Yeah, and these decisions, they are like countless. Yeah. The one that Elie mentioned about, okay, we have a buyer that has expressed interest. That's a very common scenario, by the way. People, and it's always surprising to us, or maybe it shouldn't be surprising to us, that people think that the company's unique in that respect, in that they've received an inbound offer. It's very common. What's actually even more common is that party that has initiated the inbound interest usually ends up not being the ultimate buyer, but founders don't really know this. But that having that inbound interest is an important decision point that will shape the timeline of the process. That party may have received information, they may know you, they may be a partner, right? So that party may be able to move more quickly. Now, an important decision is, how do we deal with this party? Right? Do you engage with them before you've engaged with others? Do you hold them off to bring everybody else into the fray? Do you do a bit of both, a combination, so a white glove approach with them versus also testing the market? This can be different on a case-by-case situation, but it's a very important point, and we of course take that into account. And when we draft the envisioned process timeline, we do of course take that into account.
Let's take a look at some of the common process failure points. This one's probably the most common self-inflicted problem in founder-led exits. Founders wait until they're tired, until they've been approached, until they've had conflict with their co-founders, or they're under pressure from their board or investors, and by then they're already behind. From our experience, one of the biggest mistakes founders make is waiting too long to prepare or to calibrate. When that happens, KPI definitions shift from one deck to another. The founder is still sitting in the middle of core functions, so there's a lot of dependency on them, and the board may not even be aligned on objectives or timing. None of that means that the company is bad. It just means that the company is not sale ready, and buyers expect institutional quality information even when the business is still founder built and founder led. And if they don't get it, then obviously they discount that opportunity very quickly.
And again, this also ties back to what I mentioned earlier about starting too late and starting when things start to slow down. One great example that we worked on was a situation where a founder, they knew in their gut, because look, you guys know your business better than anyone. So they knew in their gut, the company was doing very well. They knew in their gut that this is probably not going to last for too much longer. But they knew that, but the board didn't know this. And of course, it was a difficult situation where the founder felt like they should be exploring options from a position of strength. And the board and their VCs, they kept saying, look, you guys are doing great, keep going, keep going. So it was a very fine line that we helped that founder walk, whereby without communicating to the board and their investors that, look, I really think we're running out of time here, convince them that they should explore options, they should look at a liquidity event from a position of strength. It was a difficult and delicate set of conversations that took a while. And what was even an additional complication was that the company was not profitable, so they needed, a bit more funding from their investors. So how the founder communicates, how they communicated that narrative to the investors was crucial, because if the founder were to say, "Oh, our momentum is probably going to start running out," he would have a hard time raising that bridge round. So he couldn't say that. Equally, he needed to put some urgency into the board to say, look, guys, I really think we should be exploring options. So anyway, so we helped them navigate that situation. And frankly, it was one of the few businesses that received double-digit, like a very full revenue multiple, in an environment where everyone else was getting, significantly less than that. And the reason they got that multiple was because they went to market from a position of strength. And of course, they also found a motivated party that was willing to pay that multiple. But the founder didn't wait until it was too late for him to have that conversation.
Yeah, that one's a great case study.
Yeah.
Here's another one. Founders often overvalue buyer enthusiasm. This is what Georgios just touched on now, because it feels like momentum, but there's a distinction between interest and intent. Intent is not the same as the ability to close. Unqualified buyers can consume a lot of your time, months of management attention. If they're an unsolicited inbound that come outside of a process or before you've actually started the process. So the right questions are basic but critical. These are the questions you should be asking the buyer. Can they actually buy? Do they have the capital, approval authority? Can they pay what the business is worth? Do they have a credible internal process? Why would they buy this business? Is there real strategic rationale, or is it just curiosity? And what's their timeline? And what are the comparable deals that they've done before? And the point's simple: don't confuse flattering conversations with transaction certainty. And these people will drag their feet. They'll play on founder fatigue to try and get you to sell your business for the lowest number, because they know they're the only game in town. And look, it's much harder to ask these questions as a seller or a founder when you're trying to diligence the buyer if they're the only one at the table, because you feel like they might walk away and you lose them. And that's when you really need to be speaking to number one, an advisor, to see what your options are, and more broadly, a qualified number of buyers in a structured process.
Yeah, and the reason why a structured process is also important here, I mean, that's another very common thing that we see. We see companies having conversations with quote unquote interested buyers for months, if not years even. Yeah. And these conversations, they don't really lead to anywhere. They keep dragging on. So there's a bit of a teasing, or is the buyer interested? Are they not interested? Will they do something? So when it comes to misreading buyer interest, that's another thing that's quite common, right? These conversations that just drag on and they never go anywhere. So when a formal process is launched, two things typically happen. The parties that are time wasters, typically they fall out very quickly because you have an advisor in place, you have deadlines. They know that this is an environment where they need to show their hand, right? So the window shoppers, as we call them, they fall away. And then the second thing that happens is that the really motivated parties, they step up. They even come out of the woodwork, and so very quickly, you even protect your own time, you even protect your own confidential information that you may be sharing with a potential competitor, and you know exactly how to read the buyer interest. Is it valid? Are they serious, or are they not? And a formal process with a with a respected advisor will help you get to that.
Yeah. Remember, as a CEO and a founder, it's your fiduciary responsibility to calibrate the market and get the best offer out there, not sell to the first buyer that comes to the table. And also psychologically, for seller's remorse, you want to make sure that you've left no stone unturned and that you're getting the best value for your business for all that, for the past decade of work that you've put into this business. The third failure point, and this one's common and expensive. Founders often lock onto a number before the market has really been tested, usually based on old market conditions, peer stories. I know someone who sold for X, or peak cycle expectations. We call this the valuation trap. Many people still benchmark against conditions that no longer reflect the current market. Buyers care about growth quality, they care about retention, margins, strategic relevance, and defensibility. And defensibility, especially now in the AI era. They don't pay historical multiples simply because those multiples once existed. The objective of market calibration is to build a valuation view that's grounded in evidence, process quality, and buyer fit, rather than relying on outdated comparisons or founder expectations.
Yeah. Again, such an important, like if I had a penny for every time I heard a founder or an investor or a board member say, 3 years ago, we received an inbound offer or tentative discussion at this level, right? Or that company 3 years ago sold for. The reality is that timing is a critical factor when it comes to valuation, right? In 2019 versus today, vastly different market conditions. So to be referencing 2019, 2020 multiples in today's environment is just not helping anyone. And the second thing is that every company, every transaction is unique, right? The fit between buyer and seller is very different. So just because a similar company in a similar space sold for a certain multiple, that doesn't necessarily translate direct. It's a reference point, but that particular situation could be very specific. What's the best approach for founders and shareholders is to look at their own objectives and say, look, maybe I'm looking for a 10x return, or I'm looking for a particular valuation number. If I cannot hit that, then I'm not interested. That's fair. That's absolutely fine. What is truly unfortunate to see is this anchoring to lead to a situation whereby an offer that is arguably a very good offer in today's environment for the company's KPIs, for that offer to be rejected, and then 6 months later or what have you, the same founder, board member, investor go back and say, remember that offer that we had that we rejected? We should have gotten that. Let's go and ask them if it's still available. And 9 times out of 10, if you go back, usually that party will say, sorry, now the offer is less. And then what happens? You turn down that offer, and then 6 months later you go back and you get an even lower offer. I mean, that's a scenario that you want to avoid. And and we've seen that happen. It's not unheard of. So avoid the valuation trap.
The fourth point, and I would say the final, most common failure points we see is losing control and diligence. So typically deals don't fall apart in outreach or even in LOI or negotiation. They weaken in diligence. This is where buyers pressure test the entire business. So slow or fragmented responses, signal disorganization, issues surfacing for the first time, reduce trust, unclear ownership over key diligence work streams create more delays and more risk. In our experience, the major diligence themes typically revolve around IP ownership, things like data security, contract review, revenue analytics, excuse me, technical architecture. If those areas are weak or poorly organized, then trust drops, timing slips, and retrades start to appear. Diligence should validate the story, not rewrite it. So if you remember, nothing else from today, remember, these 4 failure points: starting too late, misreading buyer interest, anchoring on the wrong valuation logic, and losing control and diligence. They aren't abstract risks. They're reasons why good companies end up with weaker outcomes than they should have had. The important thing is with all 4 of these is that they're manageable. They can be reduced through preparation, through better buyer qualification, through realistic and disciplined market calibration, and obviously through tighter process discipline. And that's where strong sell side advice really earns its value. Which leads us to process control. This is one of the most important concepts in the webinar. Process is one of the few things founders can actually control in M&A. When people say process creates value, they sometimes make it sound vague, but it's not vague. Allow me to explain. So I hope we've established by now that this is disciplined processes change how buyers underwrite the asset. It affects timing, buyer sequencing, competitive tension. In our playbook, we really emphasize process clarity and competitive edge, unsolicited sell-side advice as part of what the firm delivers. And in practical terms, what that means is, a better process usually means a better buyer set, a reduced perception of risk, and cleaner diligence and stronger control from LOI through to closing.
Yeah, and remember, the old saying that time kills all deals. It's super important to maintain momentum. Having a properly structured process also helps maintain that momentum. So, critical, super important.
So, closing thoughts, and then we'll open it up to any questions. Excuse me. What founders get from an advisor-led process is, a good advisor does more than introduce buyers. The real value comes from bringing structure, experience, judgment to a process that most founders might only go through once or twice, and what could be one of the most important transactions of their lives. It starts with making sure the business is genuinely ready before buyers are introduced. From there, it's about shaping the narrative. Then it's about approaching the right buyers, controlling the flow of information, and maintaining competitive tension throughout the process, even through diligence, after a bid's been received and accepted. As the deal progresses, the roles change again. Buyers test assumptions, new issues emerge, emotions inevitably come into play, commercial decisions become more difficult as the finish line gets closer. And this is really where experience matters. We've seen through enough transactions to know which issues are material, which are negotiating tactics, which simply need to be managed without losing momentum. Having someone who's been through it before during negotiations for closing price adjustments, for example, can easily justify the success fee in just one decision alone. And lastly, appointing an advisor sends a message to the market. Buyers know they're entering a structured process. They assume there will be competition, and they understand they'll be dealing with an experienced professional who knows how these transactions should be run. And for founders, that means less distraction. You keep focus on the business. You keep your eye on the ball. You have better decision making. You have the emotion removed from the decision making, which is critical, and a much greater chance of achieving the right outcome.
I think one of the best compliments that I received recently was the client, a founder, thanking us for making sure that cooler heads prevailed when during the process and we were close to closing, there were tensions and more than once, in fact, at least 3 or 4 times, the management team would say, you know what, this is not working. We cannot work with these people. Let's just end negotiations and walk away. And that's where experience comes in, and you need to understand, is this a manageable situation, or is this just emotions talking? And again, being thanked for being the calmer heads and making sure that, and now they're doing very well together, right? That buyer and the seller, in fact, and so that worked out very well, but our experience helped them navigate what was a very emotional period. So that was one example. And then another, again, there's like countless situations, but when sometimes a buyer might try to retrade, after things are done. We mentioned earlier that once you go into exclusivity, leverage shifts from the seller to the buyer. So in some cases, the buyer may try to retrade, and usually they will go through the advisor, or sometimes they will try to communicate the message on a principal to principal level. How you respond to that is critical, right? Sometimes the buyer could be bluffing, maybe they're being opportunistic, maybe they're being serious. But how you handle that situation can make a difference in the millions. And very recently we had a situation where the buyer did try to retrade, and how we handled the situation just nipped that in the bud, and they ended up not retrading, and that saved the client millions. Now, had we dealt with it differently, maybe we had misread the room or whatnot, it would have been a very different outcome. But in this situation, just a simple one call, 30-minute conversation ended up saving the client millions. So yeah, it's another example.
Lots of war stories there. Yeah, you can do a webinar just on those. All right, so to wrap up, hopefully you can start to appreciate that the best exits aren't accidents. They're the result of deliberate preparation, very disciplined execution. In our experience, the companies that achieve premium outcomes treat exit readiness as a business discipline well before they calibrate the market. So better documentation, better team structure, a better operating model, all create optionality. They improve buyer confidence, they reduce founder dependency, and they reduce value leakage in the final stages of diligence. Remember, you don't need to force a transaction, but preparation can't wait until the day that you decide to sell. So this is the first of 6 webinars. We're running 2 sessions per day. This is the second session. If you're interested in, I know that some of you have signed up for all 6. Tomorrow we're going to talk about how to engage with buyers and buyer psychology. And then on Friday, we're going to talk about valuation and valuation maximization drivers. And we're going to go into some case studies on how to engage with buyers and how they look at maximizing value. A few weeks later, we're going to look at letters of intent and how those are structured, what to look out for, what should be included, what shouldn't be included, and what are red flags. After that, it's closing price adjustments and deal mechanics, so you can see things are getting progressively more advanced. This one's interesting because the headline number that you see at a bid isn't always usually what you get at closing, and a good advisor can basically save you millions in what you walk away with if adjusted properly. And then the final one is earnouts and deferred considerations. Earnouts get a bad rep, but if they're structured properly, they're a great way to increase upside for founders and bridge valuation gaps. So that's it. Thank you for attending. We'd like to open up for Q&A. If anyone has any questions, please type it into the chat. If you want your mic to be activated, let me know, and we can do that. Or if you want to have a private discussion later, we're also open to having one-on-one conversations. And obviously, we'll share this presentation with you all, so that you can have it as part of your notes. Any questions? Here we go. What's the number 1 driver of enterprise value?
I can take that.
Yeah, go ahead.
I love that question because the answer can sometimes be surprising. So then there are two main drivers of value, of enterprise value. The number two is timing. And there's two types of timing. There's market timing and there's company timing. Market timing you cannot control. But a huge value driver, for example, is whether you decided to transact in 2019 versus today. Huge value driver. Same company, different market conditions, huge value differential. Yeah. So a very important value driver is market timing. The second type of timing is internal timing, company timing, right? Where is your company on its journey, on its KPIs, on the magnitude of your revenue or your EBITDA? That's the second driver of enterprise value. If you're looking to achieve a certain dollar amount in enterprise value, but your KPIs, your revenue, your EBITDA doesn't support it, then timing is just not right for that transaction. So timing is the second most important driver of enterprise value. The number one most important driver of enterprise value is who's on the other side of the table. Who's the buyer that you are talking to? The same asset is worth very different amounts to different parties. Yeah. And in today's environment, what you want to do is have what we call a motivated buyer at the table. A motivated buyer is someone who wants a product like yours, who has a mandate from the board to buy and not build it. Ideally, they're losing customers because they don't have this product. And that motivated buyer will pay above and beyond what everybody else will pay for the exact same asset. Yeah. So those two, timing and who's on the other side of the table, are probably the two most important drivers of enterprise value. Now, these are all qualitative factors. There are, as a third, fourth, and beyond drivers of value, then you go into the more quantitative ones, and then growth, right? Top line growth is probably the most important quantitative factor. If you're a SaaS business, GRR is the next most important. NRR comes third. Profitability is a gating item. It's not a value driver, and that would be number four. But again, valuation is not formulaic. There's no formula where you put in your GRR and your revenue growth and you get an answer. It's not a formula. If it was a formula, everything would be super easy. You would just show them the formula to the buyer, and that's it. It's not formulaic. It's a narrative. It's a discussion, and it depends on all the factors that I just mentioned.
Here's another one for you, Georgios. On the market timing question, what time is it in the market today? And where do you predict market conditions to be in 18 months? How does a founder, CEO make decisions today that drive EV outcomes 18 months from now?
Good question. Look, market today is okay, right? It's not bad. But it depends on the company and on the situation. It's hard to generalize. If you're going to generalize, market conditions today are good. If you're an AI company, market conditions are great. If you are a threat of being replaced by agents, market conditions are terrible. So it depends. It depends on the situation. But big picture, market conditions at the macro level are not bad. And then how can you make decisions today to drive the enterprise value in 18 months? I'll tell you what. A couple of things you can do. The simplest thing you can do is do what you feel is right for the business, right? That's the simplest thing. So some founders have asked us, should we be cutting costs to become more profitable? Should we be investing more in sales, right, to show more growth? So the generic answer is do what's right for the business. Don't do something that is window dressing or that you think will become something that's appealing for the buyer. Don't do that. So don't cut costs just because you think the buyer wants to see more profitability. Do what's right for the business. And then the second thing you could try to do is what we mentioned at the beginning. So basically look backwards and say, look, 12 months from now, 18 months from now, what are the important KPIs that I want to have fixed? I want to fix my top line growth. So I need to do X, Y, Z. I need to improve my retention. So I hire more customer success folks. I want to lower my customer concentration. So I do X, Y, Z. I want to lower the dependency on the founder. So these are the steps I will take. So that's just some examples. And I think beyond that, I think we can look at this on a case by case basis.
Another questions come in. Buyers now care about defensibility, especially in the AI era. What does a defensible tech business look like to a buyer today? And has that definition changed in the last 12 months?
Okay, I can take a stab at that as well. So there is a lot. So AI is front and center on every buyer's mind, especially private equity, but also strategic buyers. So maybe a lot of you have heard that some private equity firms now try to vibe code, the solution that they're looking to invest in, just to get a sense for how easy it is to replicate it, and if there's a moat or if there's a different defensible aspect to the company, whether it's whether it's data or something else or some other expertise that's hard to replicate. So it is front of mind for just about everyone. For the buy, for the corporates, for the strategics, the buy versus build equation has changed. Building has become easier. Yeah. So if you have a point solution, a feature, then your position is not very defensible. That can be built much more easily. Historically, we used to have kind of point solutions that would get acquired and get plugged in to another strategic. Today, that's more likely to become a build versus buy situation. But defensibility, a lot of times, there are some segments, buyers will fast forward 3-5 years, and they will say 3 to 5 years from now, where do I think will be the capabilities of AI and agents and whatnot, and then they will try to assess the effect that might have to your company. Again, it varies on a case-by-case basis, but you definitely need to have a very credible story and narrative on your defensibility.
Yeah, and we're seeing higher stress points on gross revenue retention, retaining customers and retaining revenue. We've seen that come up higher on the requirements list over the last 12 to 18 months, because buyers are afraid of purchasing a business that can be easily replaced, and then paying a high fee for a customer that eventually for a acquisition that eventually churns all its customers.
I'll say one last thing on this before we get the next question, but the good thing about where we are with the AI hype cycle is that it feels like 6 months ago we were at the peak of the hype cycle, so people assume that AI can do anything. So kind of fear levels were sky high. That's why we had the SaaS apocalypse in the public markets. I think we're off of that now, and we're coming off of it more and more. Firstly, because people see that the LLMs and the underlying models are still not quite there. Secondly, there's the energy costs that affect that may affect adoption. And then all this kind of starts to bring some more reality into the decision making.
And one more question. What happens if a company goes to market and the offers come in below expectations? Do you want me to take a crack at that?
Go for it.
So we see this a lot with privately held and founder-led companies, which is why when we go to market, we want you to think of it as a calibration process, and that's important psychologically. So it's not necessarily the end. We're going to speak to the market. We want to understand how buyers value the business. We want to understand where they feel the strengths lie and where the weaknesses lie, and get a kind of a price discovery process. Sometimes when that happens, we have situations where the bids come below expectations, and buyers might highlight issues like, for example, the gross revenue retention, or they might highlight customer concentration or geographic concentration issues. And we say, look, this feedback is extremely valuable. Take it away. We'll take you off market. Take this information away and work on your operating model. So I had a scenario where the buyers were interested in the business. They bid, but they didn't pay a premium because of customer concentration. Our client took that information away. They professionalized their sales team. They hired a CRO, and they started winning clients that diluted that customer concentration. And about 10 to 12 months later, we relaunched them back to the market. During that time, we kept conversations warm with the buyers. We check in every few months and give them updates. And when we felt the time was right, we relaunched them back to the market. So we call that a controlled pause. That's part of our commitment to our clients, is that we'll stay with you until the very end, until we find the right buyer and the right market conditions.
Yeah, and that feedback is crucial, right? Because bids and offers may come below what was expected, but almost all the time, this will also come with feedback, right? So that feedback is invaluable, and then you guys can take that away and decide whether it's addressable, whether it's not addressable. Maybe you can adjust your and your shareholders' valuation expectations, or maybe, as Elie said, we can do the controlled pause and then come back to market at a later time when conditions could be different.
Okay, another question. We have had some approaches recently and have shared some initial info with a potential buyer. What is the process to engage with yourselves, and what is your minimum deal value that you would look at leading?
Okay. Obviously, we could take this offline, but the high level question is, the high level answer is, in terms of minimum deal value. I mean, there is a minimum deal value, but usually it depends on our level of conviction that we can get a deal over the line. That's typically the swing factor. If we think we get a good deal over the line, then we can discuss on a case-by-case basis if it's too much on the low end. It's hard to say kind of generically. But in terms of process for engaging with Venero, let's do an offline chat. We can arrange a call, understand the situation a bit better. We can share our thoughts on what we think is a likely outcome, and then we can discuss from there. I think our first step would be just to have a chat, more kind of nuanced chat, depending on the specific situation.
One thing I would add to that is, if you are having conversations, and this is not in this specific situation, but in many situations, don't lead with valuation. The reason for that is, and it's very difficult to do, the reason for that is, number one, you don't want to anchor to a lower figure and potentially leave money on the table if the buyer was willing to pay more. And number two, you don't want to scare them away and anchor too high before they've had the opportunity to really understand the business and get invested in the opportunity. So when we get this question, asked a lot of time, what's our company worth? We calibrate to the market. We ask the market to come back, and then we give them guidance on where we think they should be. Okay, if that was a great session, lots of good questions and a good discussion. We hope you found it valuable. We hope to see you at in the remaining sessions tomorrow, after tomorrow, and in a few weeks. And yeah, if anyone wants to have a private conversation, you've got our contact details. Please reach out. Thank you very much for your time, and yeah, we look forward to seeing you in the following sessions.
Thanks, everyone.
Thank you.